Welcome to Subramani. There are a lot of behavioral biases which we see, and or financial behavior biases which we see. One of them is recency effect. So if somebody sees a chart showing 30% CAGR on small cap funds over last 10 years, then they say, oh, all the money should only be in small cap fund. Why should it be in large cap fund? Why can't we put all our money in small cap fund and over the next 10 years make so much, make 30% or something like that? We all need to understand that all my funds which are looking very good are an unbelievable chart of 2020. So whether I entered in March 2020 or even in July or September 2020, today I'm sitting on 30%, 35% kind of return on small cap funds, some mid cap funds and some infrastructure funds. So that is the skill of the starting point. So you cannot translate that. The growth that you got in your portfolio because of change in PE is not likely to be repeated, because in 2020 it is the market which had not crashed, it is the PE which had crashed which took the market down. So when the PE changes, that is the time when you get the maximum return. So for you to get a 30% return on any company or on any portfolio, all the companies profits and profitability has to be good, and the profits have to grow at 30% if the same PE if you have to make money. That is not happening. So companies would be growing at 7%, 8%. So then the question is, will the growth be 30% when this growth is 7-8%? Yes, provided it started at a lower end. So if it started at a lower PE, suppose the market was at a PE of 7 when you started buying, and now the market has reached the PE of 21, has reached a 21 PE. 3x return you got just by the change in PE, not by the change in EPS. Now, for you to have any further growth, the earnings and the PE both have to change for you to get good returns. But that's not the purpose of this video. The purpose of this video is to remind you of a story called LTCM, or long-term capital management. Long-term capital management was run by very sophisticated Nobel Prize winners, etc., who said, oh, we have estimated how much we can lose. We cannot lose more than $35 million or things like that. And in a very short period, they lost something like 250 million, right? So that's the kind of fall which had happened. They started the year with $4.5 billion of net worth. They crashed. They were down to 555 million. And at that stage, it was Warren Buffett who said, I will buy you out for 250, right? So look at this, 555. Unfortunately, they couldn't find buyers. That's a very important thing. Understanding that suddenly in your asset class, if the buyers disappear, there is no way you can do anything. So whether it is a credit fund, credit risk fund, so whether it is a credit opportunity fund or a credit risk fund, as you look at it, you realize that when the liquidity vanishes in that market, you will not be able to sell even your Tata Power bonds at yields of 9%, 9.5%, because people say, no, I don't want to buy. It may be a Tata Group company, but I don't trust, right? So suddenly liquidity vanishes even in the top quality rated AA paper kind of stuff. AAA is still liquid, gilt of course is liquid, but even in AA liquidity vanishes. So when liquidity vanishes, you can make a ridiculous offer and say, oh, I will give me a 20% discount, give me a 26% discount. I remember in April 2020, offers were being made for the complete portfolio of Franklin Templeton for 26% discount. I think somebody from Hong Kong made that offer of a 26% discount. History is they recovered all the money, they have been able to repay everything. But what is important is to understand that if you were to invest in credit risk fund, it better be a very big fund. It better be a close-ended fund so that people don't have liquidity. So it could be an AIF with a 7-year lock-in. Then I'm willing to invest in a credit risk fund. But otherwise, generally investing in a credit risk fund, the risk is not that you will panic. The risk is that the others will panic and therefore the fund will make a loss. So it better be a close-ended fund. But my argument is, look at the kind of deals which get offered only to people like Warren Buffett, simply because he's sitting on so much of cash. It allows you to make ridiculously attractive deals, attractive for you and very cruel on the person who is being forced to sell, but you are here to make money. So India also has seen such stuff. One of them, if you remember, was this deal that the Reliance Group had with CNBC. It was, of course, money lending kind of a thing, but the agreement and the wordings and what was at stake was, it was forced into a deal and the company got taken over. I've heard there was one businessman who wanted to sell his business, and I was talking to one of the potential buyers and I said, you are perhaps the only potential buyer who can pay that kind of a price and take it. He said, and I said, he's asking for a price. He said, yeah, I know he needs money, I know he needs to be pulled out, I know he's asking me for money, I know he's bending. I want him to bend, I want him to rub his nose on the ground, and I want to see his nose bleed, right? This is what people with cash can do. Should you sit with cash to look for opportunities? Both are right. So somebody will tell you time spent in the market is more important than timing the market, but you can do a combination of the two. Sitting on cash is not a bad idea. Sitting on cash looks like a bad idea when you think that other asset classes are doing very well. When you see small cap fund growing at 30%, when you see infrastructure fund growing at 22%, you feel odd to be keeping your money in any fund which is getting you 5-6%. It is as though your active funds or your equity portfolio is laughing at the cash in the bank and saying, look, you are earning nothing. But today is not a bad time to be sitting even on cash, because even your funds are giving you 6-7% in debt, right? The way debt is taxed and all that, that's a completely different thing. But staying in debt today is not such a bad idea, because tomorrow you could get better opportunities to invest. Is this a market which is going to run away, and are you going to look back maybe in 2025 and say, oh my God, I should have invested in 2023? Maybe not. How much soever the market runs, this is not a cheap market, right? So sitting on cash looks very, very contrarian. Putting money in large cap funds looks like very, very contrarian, and I'm making this video on 5th of September. Happy Teachers Day. And but it may not be such a bad idea. At any point of time, the best asset class is the one which looks the worst, right? So how does it look? That is more important. So we are all performance chasers. At some stage we will all chase performance. We are chasing performance. Even though we say we are not chasing performance, the fact that everybody wants to put money today in a small cap fund because the CAGR looks good is proof that we all love to chase performance. Whether you are an investor, whether you are a mutual fund distributor, whether you are the manufacturer himself, whether you are the mutual fund itself, we all chase performance because that is how it is sold. So sir, this fund is doing very well, it's a good time to invest. I think the worst asset class over the last 6 months should have been cash. Because if your cash is kept in savings bank account, it is getting you 2-2.5%. Of course, if it's in even in a liquid fund, you would have got 6-7%. So you got some returns on cash, but sitting on cash is not a bad idea. That's why the LTCM story and the fact that Mukesh Ambani regularly gets such deals saying, will you take this over, because we don't have the money to run it, right? So to run an infrastructure company, like if you've created an airport, it might take a long time for the airport to make money. After that, it will make a lot of money. But during that period, do you have the cash to wait, the ability to wait, the ability to sit on cash patiently waiting for good deals to come your way is not easy. And it's fairly obvious that it is only Warren Buffett or Mukesh Ambani who will get such deals. But you could also get a deal if you are friendly with some money lender who does home loans. I have seen people getting such offers saying, can you make the payment in a week? This house worth 2 crores is going for 1.6, 1.7, because the owner is desperate. He has got some business problems. And if you know some people in the retail financing industry of homes, mortgages, you could get such offers. You could use your cash, buy it, wait for 6 months, sell it off and come back. So the cost of waiting with cash looks very high, but it will completely be taken out with one deal like this. Over 10 years also, or 5 years, if you've got one such deal or two such deals or three such deals, it will be a great time. Yes, you don't have much money, you have small amount of money. Wait, when the market comes down, all these things which look very attractive now will look more and more attractive. So sitting on cash has its advantages. It is like you having an air-conditioned restaurant in the middle of a desert and offering cool water. Nobody else is doing it. Thank you.